Hello, I'm your host, Ray Dogum, and welcome to VibeCast. Thank you for joining us as we explore the exciting advancements in technology-enabled collaboration to excel important drug development. Vibe Bio seeks to find every cure for every community. Join us to learn, imagine, question, and help us identify and develop solutions together. Our guest today is Derek Brunelle, founder of Synthase Capital Partners, and previously an executive director at JP Morgan and managing director at Silicon Valley Bank. Derek, welcome to the show. How are you doing today?
Good. Thanks for having me, Ray.
Yeah, I'm excited to have this conversation with you. I'm very interested in learning about your past experience at these banks, as well as sort of more to learn more about Synthase as well, and why you started that.
Yeah,
So maybe we can get started with you just introducing yourself a little bit more and sharing your background.
sure. Yeah, Derek Brunelle, and as you mentioned, I'm a founder and managing director of Synthase Capital. Um, Grew up in Vermont, attended the University of Vermont, moved to Southern California 23 years ago, got started in banking at what was then Union Bank of California, and then in '06 joined Silicon Valley Bank and was there for 12 years doing a kind of a combination of supporting both technology and life science companies. And then in 2017 had the opportunity to join JP Morgan as they were building out their early stage life sciences practice and worked there for 4.5 years. And now I'm off on my own, still active in the life science ecosystem, working with clients, helping them source both debt and equity capital, as well as doing fractional corp debt work for companies as well. So
Awesome.
happy to dig in anywhere you want.
Yeah, I think maybe just defining debt for life sciences and like because there's so many different financial instruments I think people can use or leverage in order to keep their companies afloat. Maybe just kind of defining venture debt and different types of capital.
Yeah, it's a good point because there's a lot of different terms mixed around, but essentially venture debt is debt that's typically placed with companies that are venture-backed institutional VCs that are still either pre-revenue, which is often the case with life science companies, or pre-cash flow positive. So these companies are typically funded by institutional capital providers, VCs predominantly, but they can be corporate VCs as well as financial VCs. And sometimes boards and management teams look to layer in debt capital on top of an equity capital raise. And there's a number of reasons why a company might want to do that, but oftentimes it's best used as a lower cost of capital insurance policy, if you will. It's kind of a simplistic way to think about it. So oftentimes companies are burning money to get to some sort of a milestone, could be a clinical milestone, regulatory milestone, and having a little bit of extra liquidity in the form of this debt vehicle can sometimes be beneficial. So companies aren't running out of capital ahead of a key value inflection point.
Got you. So it's sort of supplementary to the invested capital.
Yeah, I think that's an important distinction. Debt is debt. It has to be repaid. It's never really good to think of it as a replacement for equity. It's really a supplemental source of capital that is a lower cost of capital. And then there's other ways to structure credit as well in certain different situations. You might see companies that are late phase 3, early commercial, look to get credit to help them kind of front load or finance actually some of the startup costs associated with building out a sales team and whatnot. So there's within the venture debt landscape, there's a number of different products that get structured and deployed depending on where companies are in their life cycle.
Interesting. Let's take a step back and sort of talk about what got you interested in life sciences financing in the first place. Like why life sciences over something else?
Yeah, I think I have to be clear that I always view myself as somewhat of an accidental banker. I mean, I studied finance in college and I enjoyed just the rigor of that. Got exposed to some accounting as well. When I graduated, I wasn't exactly sure what I wanted to do. And a friend of mine worked for a small bank back in Vermont as a credit analyst. And when I got out to California, I was looking around for a job similar to that. Figured it would expose me to a lot of different businesses, would leverage my college degree, and just give me a platform to kind of learn and go from there. And I kind of just uh, started to enjoy what I was doing at Union Bank at the time. And then, when I moved to Silicon Valley Bank, it really, that environment, that culture at the time, this was in '06, it really clicked for me. I was able to interact with a lot of companies, both in the technology and the life science ecosystem, had access to VCs, C-level executives at a fairly young age relative to what I might have gotten exposed to at a larger bank, candidly. So it was just really stimulating. And then, I moved to San Diego probably '07, '08 timeframe, and was working with a number of tech companies. And then an opportunity developed in the San Diego market within SVB to join their life sciences team. And for listeners who maybe aren't aware, San Diego is one of the larger life science ecosystems. And so for me, I was just thinking of it as, from a career perspective, there's probably more personal runway for me here in the life sciences ecosystem versus focusing on tech. And that's played out, I think, pretty well. Although the tech ecosystem in San Diego is also pretty vibrant. So, and I really just started to enjoy working with life science companies. There's, not to get too over my ski tips about this, but there is something fulfilling and rewarding when you're working with companies that are developing tools, technology, devices that are, potentially going to have a big impact on people's lives. So that resonated with me. And after working in the ecosystem for a while, I just felt like, yeah, this feels right. I have a certain set of skills. I have a network. I liked the bigger mission, if you will, that I can enable through the work that I'm doing, and the relationships that I have with my clients. And so just kind of fit. And I'm grateful for the opportunity to do it. This is a great market. Obviously, it's a great part of the country to live in and raise a family, and feel blessed to be able to do that.
For sure. And I could certainly resonate with the, sort of passion and interest in life sciences and healthcare in general as well. Just having that feeling of being able to work on something or help people work on something that's so impactful to human life, as opposed to maybe helping a company try to figure out a new way to rent a car or something, or fintech.
Yeah, I mean, I think everyone has their skills and their calling. I think for me, having worked with a number of tech companies that were doing things that were all, albeit interesting, didn't have that same kind of emotional connection for me as working with early stage and growth stage life science companies does. So it's hard. I wish I had maybe studied a little bit more hard science in high school and college, but I'm doing what I can to keep up with it. But I enjoy the challenge, and again, the work that people are doing has the potential to have a big impact, potentially in my life, my children's life, family members, and just broader community. So
Yeah, and I'm sure.
that resonates.
Yeah, and through that, not having that engineering or life sciences background or biology background, you probably have to leverage a lot of other experts to help you sort of navigate some of those more complex domains at certain points.
Sometimes when you're working with different management teams, they'll ask you, like, do you have a background? And if you don't, they will ratchet their communication down a notch or two. But, candidly, I think by nature I'm a curious person, and I like to be put into situations where I almost don't know things, and I spend a lot of time researching, Googling, YouTubing, whatever, getting into the scientific literature, and I like that.
Yeah.
So, almost like the more complex it is, the more it gets me excited to dig in, and it does get complicated at times, but it's also fascinating when you get into some of these stories. And then I have a much greater sense of just the progression of basic science in how today's discoveries when you start going through the literature. It's like built upon layers and layers and layers and layers and layers of stuff that goes back decades. And again, not, being exposed to it, but not being intimately in that ecosystem. It's like, wow, there's a lot there.
Yeah, I mean, I think it's just really cool that you've been able to kind of watch that space grow over time, the whole biotech space in general.
Yeah.
Because, the types of therapies and advancements that we're making today are very different than the ones that they were making in 2005 or 2010. So it must be
Yeah.
really rewarding just in that sense, just having been able to follow these companies through the years.
Yeah. Well, it's certainly, I mean, I think it's a cliche, every moment is the exciting moment, right? But I think what we're seeing a lot of now is a confluence of, the hard sciences with technology, and you have this growing tech bio um, ecosystem, or sub vertical or subsector, however you want to describe it. And it's exciting to see some of that stuff finally, I think, reach escape velocity. And I think that is one of the trends that's going to impact certainly drug discovery, clinical trials, patient care outside of a clinical setting for decades to come. So I think that's really encouraging.
Awesome. So remind me, when did you found Synthase Capital Partners and what motivated you to do so?
Yeah. So early this year, so separated from JP Morgan last summer when that was fine. I was looking around for kind of my next thing. I enjoyed deploying capital when I was on SVB's platform, and I was talking to a couple of different funds and banks, and the labor market was pretty tight. And so I felt like, okay, I got to do something. I like the ecosystem. I have a network. I got licensed to do private placements while I was at JP Morgan. And so, I talked to some other folks that have launched their own kind of solo advisory practices, and they're like, okay, maybe that's like a good next step for me. It enables me to put myself in a position to earn some money while also activating my network and growing my network, candidly. And so I incorporated Synthase Capital Partners in February, worked to get, website stood up and all that stuff. And then I formally launched on a LinkedIn post back in June, and we're off and running. And so I think for me, it was the next best thing to kind of leverage the skills that I have acquired over the years and position myself for a whole range of opportunities. And that's what's kind of playing out right now. I'm a few months into this. I'm working with a couple clients, um, having some good traction with a few of them, talking to one about potentially taking on a greater role at some point in time. So I'm really enjoying what I'm doing. And I think there's really strong alignment between what I want to do and what the clients that I'm working with need. And that feels good.
Yeah.
It makes me feel good, and I think directionally I'm on the right track.
No, that's sounds really great. And it's always nice when those two things overlap, right? Your interests and what clients want. So
Yeah.
it's
Yeah.
awesome. How do you evaluate the viability and potential of a life science company when you're considering them for either an investment or a loan?
Yeah. Good question. I'll take the easy one first. So from a credit perspective, venture lending or venture debt, it really hinges on a company's ability to raise that first institutional round. So usually what happens is a company would raise a large Series C or Series A, and then they would kind of become a candidate for venture debt, either from a bank, a boutique bank, or a non-bank fund. So the underwriting criteria that a lot of the banks or funds use is, one, did they raise, institutional capital, and if so, from whom? And you're trying to, look back at that investor syndicate or that investor and being like, hey, do they have a track record working with life science companies or not? And the other thing you're trying to assess is, the equity that they just raised, how long is that going to last? So you're trying to get a sense of their runway, burn rate, when might they need to go back out and raise capital, and what milestones or what activities are going to happen in between now and that next raise time frame, to try to get a sense of, you're trying to handicap whether or not the company is going to be able to raise a subsequent round of equity, because at the end of the day, that's really your source of repayment. Valuation, appreciation, as well as their ability to attract new equity capital. So that's in a nutshell what you're trying to identify. From an equity standpoint, I am working with a couple of companies right now on equity capital fundraising projects, and I think a lot of your listeners would obviously agree that the fundraising environment right now is pretty challenging, and it's there isn't really if you just look like this, you're going to get funded. I think there's a lot of disruption right now in the capital markets, and even companies with strong pipelines, decent runway, strong management teams that have raised from venture and returned capital are still, having a hard time. So I think, novel science, strong teams, big market potential, are always going to be hallmarks that people look at when making equity investments. But I think it's also important for capital seekers to also have an appreciation for where we are in the cycle and how their story fits, and how their story needs to fit in with the investor's business, which is to generate returns for their LPs.
For sure. And you mentioned there are certainly different subsectors or subcategories of life sciences. You have biotech, you have medtech, diagnostics, I guess tech bio, if you want to call it. Do you have one that you really specialize in or prefer to work with?
From a credit perspective, I have some experience with the different sectors, biopharma, device, med device, or diagnostics and med device. I'd say therapeutics tends to be an easier space to deploy debt capital into post and equity financing. Partly because the quantum of capital that those companies raise is usually a bit larger. Okay. And they're often valued on the promise of their pipeline. Device is a little challenging because there's a smaller pool of potential buyers. There's only a handful of big device companies. So exit markets are a little bit smaller, and a lot of the buyers want to see device companies get early revenue before. So you could go through an approval process, but still have to fund early revenue, which can be tricky for companies to do. Diagnostics has its own set of challenges around reimbursement and getting paid for utility of some of these tests. And so there's been some great success stories in diagnostics, but there's also been some really challenging situations as well. So I'd say therapeutics is where I tend to focus more of my time, but I'm kind of agnostic as to any life science subsector, to be honest.
Gotcha. Could you share maybe a success story about a company you've provided debt financing to?
Yeah,
I'm sure there's many.
there's two that stand out for different reasons. Both of them happen to have been based in Utah for some reason, which is interesting, but both were clients that I had at Silicon Valley Bank. One was a company called Zarbee's, which a lot of you might know. They sold and they continue to sell like honey-based cough syrup, primarily targeted to children, and they've expanded their product lines. And it was kind of like this misfit within SVB, where it certainly wasn't a tech company, it wasn't a life science company. We ended up managing the relationship in the life sciences group, and I was fortunate enough to provide some debt capital for them to help them scale up their business. it was just an interesting one to work with because it was a consumer packaged goods company with, you know, supply chain issues, distribution issues, and then this other wrinkle, which is the seasonality. And so, like every year, they're like looking at forecasts for the flu and using that to help figure out how to forecast. So it was just like again, it was like intellectually stimulating company to work with, and the product literally is sold at you know pharmacies, grocery stores. So even today, when my kids get sick, my wife's like, "Can you go get some Zarbee's?" And so it just clicks with me just from that reason. The other one is a company called Lineagen, which is a diagnostics company that focused on autism. So they did genetic testing for children had developmental disorders in addition to autism. And so that was a company where we provided working capital line of credit to help them manage their receivables, get some liquidity from their receivables, as well as what we call like a growth cap facility, growth capital, which is like a term loan to help them kind of scale up operations. And what was interesting is the CEO of Lineagen, Dr. Michael Paul, is someone who I'm also working with now on a new company that he's involved with called Mara Bio, which is also in the autism space. And so what stands out to me was just the relationship that I built with Michael and how that persisted over the years, and then now we're working together again. So
yeah, thanks for sharing that, and that's a good point you bring up. Maybe what advice can you share with biotech, life sciences entrepreneurs on the art of navigating like banking relationships?
yeah, well, a lot's changed in the past couple of months for sure.
Yeah, or last year as well. Like
Um,
if you just think
I
about
think
SVB and all that, but yeah,
I think what's been interesting for me personally is that when I was on the banking platforms I was on, JP Morgan, Silicon Valley Bank, you see the world through bank products. And I guess that makes sense, right? Because that's what you're selling and that's where you work and that's all you know. Now that I'm not on a banking platform and I'm in many respects kind of more involved with companies tactically, I have a greater appreciation for all of the other problems, not problems, but challenges that they're also trying to tackle as they scale their business. So for me, the advice is I think from a banking perspective, you certainly want to make sure that you're working with a partner that, for the most part, understands your business and has a team in place that knows what you're trying to do as an entrepreneur, founder, startup company. And I think that's candidly how SVB, Square One, PacWest, Bridge Bank, some of the boutique banks kind of differentiated themselves. Landscape's changing. I was a part of a team at JP Morgan that was trying to bring that type of culture to a larger bank. And I think now you're seeing that accelerate on JP Morgan's platform. You're going to see it expand on MUFG's platform. Stifel, there's like HSBC's just launched an innovation bank. I think for me, it's like, the products on balance are pretty much commodities, but it's really trying to find people within the banking organization that can understand what you're trying to do and help you get your business a little bit further along than if you were to just shop around for the cheapest whatever. Or I think convenience is certainly important, but having a team behind you that gets your business and has a network that they can bring into certain situations, I think is helpful.
yeah, it's certainly not just the amount of money you can get or the interest rate. It's the people.
Yeah, I mean I think what you're seeing now is, and I guess it's kind of obvious, but I think given the issues with SVB earlier this year, I think it's going to become the norm to have multiple banking relationships.
Mm-hmm.
And I could see a situation where a company has a banking relationship with a money center bank, and that's manages certain things.
You said
Maybe
money
that's
center
directed by
bank.
the yeah, like a large, like a JP Morgan, a Wells Fargo, B of A, Citi,
Okay.
and then maybe a banking relationship with a boutique bank like an SVB or a Bridge Bank, or even some of the fintechs that are coming up, whether it's Brex or Mercury. Um, I like some of the things that the fintechs are doing as it relates to making it easy for founders and executives to actually take care of the stuff they need to take care of from a banking perspective.
Gotcha. So thinking about the future of banking, we talked about this in our pre-call. What is
Yeah.
banking 5.0?
Yeah, I don't know if it's 5.0 or what, but so part of my vision for Synthase is multi-pronged, but one of the things I was kind of wrestling with when I was even at SVB, more so at JP Morgan, was I just didn't feel that the organizations were doing enough to really accelerate innovation
Hmm.
and leverage their networks to bend the cost curves down. Um, just saw a lot of companies kind of struggling with similar things. Some of it was adjacent to moving money, some of it was not. And so for me, I think the technology exists now for there to emerge what I kind of call like hyper verticalized banking institutions.
What do you mean by
So you could see a fintech company that is purpose built to accelerate innovation for therapeutic life science companies.
that? Okay, like very focused.
And the technology stack incorporates lab ops,
Mm.
all these other software solutions that are being used by development stage companies. And then tucked in underneath that platform is an embedded banking relationship with a JP Morgan or a B of A or a Wells Fargo, right? And so you get kind of the best of both worlds where you get technology forward fintech partner that's super up the curve on your ecosystem with all the, safety, soundness, product capabilities of a large bank. I think that's I think that's the future.
Gotcha. And I imagine most of these um, companies are leveraging their CEO or founder or maybe their chief financial officer to form those relationships with the banks and
Yeah.
negotiate and talk through these deals. Do you also recommend that these startups have funding advisors on their side to help them?
Yeah, life science is a bit, well, I think startups actually are unique in that a lot of startups work with fractional advisors.
Mm.
A lot of the life science companies that I work with have contract relationships with advisors that are focused on, talks or preclinical development or assay development or whatnot, fractional CFOs, bookkeepers. Many of them are trying to keep their overhead lean and they don't quite have enough transactional volume to justify full-time CFO until they raise, Series A or Series B. From a funding advisor perspective, what's interesting, and this is what I've kind of learned since I've started, is a lot of the credit investors, so banks, non-bank funds, there's a universe of advisors that work to place debt capital. And the banks and the non-bank funds are kind of used to working with those advisors. When you get into equity capital projects, I think it's challenging for a lot of VCs to gain a lot of comfort in the management team if they're working with a boutique bank or a advisor to help them raise private capital. I've heard from I've discussed this with a couple of VCs, not, a large sample, but I think the feedback is they want to be able to see the founding teams identify, pursue, get introductions, you know, hustle or navigate the fundraising maze, because that to them is, it's kind of a sign that they have, whatever you want to call it, the skills, the ambition to kind of raise the money. Capital raising is a hugely important part of fundraise or of starting these companies, right? And if you can't do it, you're going to have trouble. Now, I kind of have mixed feelings on that. Um, I think there's always room for people to lean in and provide support, either through, helping a first-time founder, an academic founder, working on their deck, working on the positioning, working on building out a targeted list of investors, trying to do what you can to position them for warm intros. But I think, the responsibility still primarily lies on the foot of the founders to really manage that process. I think folks like myself can augment that, but there's a little bit of a fine line, because I think some of the investors are candidly turned off by it. So going to be thoughtful about that.
Yeah, I see what you're saying. And hard to raise money as a founder, especially now. It always was, right? And I think the time that they have to spend refining their pitch, their story, their decks, traveling,
Yeah.
having these conversations, um, it sort of is a grind. And I think it's safe to say
Yep.
that many of them feel like it can feel like a waste of time sometimes. But one thing I've learned is every time they do make that pitch, they are learning something about themselves, the company, and then the questions that they get. So it's not all a waste of time. It's just a practice. It's part of the process in a way.
Yeah.
Some might say
Yeah, I agree. I
money,
think
but it's not. It doesn't work that way.
I think it's I think for me, where I've kind of landed on this is, I think candidly there's startups and fundraising and success around fundraising gets hyped up quite a bit, right? And you usually just read about the companies that got funded. You don't, when you look at PitchBook, it's like they're telling you all these things, but they're not telling you the other side of the story, which is how many people are actively out in the market today trying to raise capital. And what I don't have a sense of is how much people appreciate just how competitive it is. And particularly for first time founders or first time teams, they're competing on many different fronts, right? They're positioning their idea against a whole sea of other ideas, but they're also positioning themselves against other founding teams that have a track record and have a network, because they've raised capital before and they've returned capital before. And if you're an investor and your primary job is to generate returns for your LPs, that's your business. It's really hard to take a pitch from a first time team who's trying to create the future with the technology, but it's the first time that they're trying to do it, right? And so um, I have a lot of empathy for entrepreneurs that are launching into this endeavor, but I would just caution them to think about the equity capital supply chain, how money flows from limited partners to general partners. Really study like VC math and portfolio math, and try to align your story in such a way that your opportunity aligns with the fund. And if you can articulate that succinctly, I think you'll have some success in at least getting the attention of a prospective investor.
That makes sense. You should be, able to cater to the specific investment firm you're going after, and adjust and change some of the details about what you're saying so that it's
Yeah, but that's what makes it time. I mean, that's what's time consuming, right? It's like, if any, I think we've all, applied for jobs, and you're like, oh, I got to tweak my cover letter for this thing, and it's like, multiply that by, the number of
200.
investors that are, there's something like, I don't know, 500 plus life science investors. There's a whole range of them, whether they're active or not, but it's daunting, right? And that's where I feel like that's where I can help in winnowing down that list for companies, running through the resources that I have, just trying to get a targeted list. And then once you have that targeted list, like, okay, like what do we think is going to resonate with this particular investor, right? What's the story that we want to put in front of these teams, and how do we get in front of them?
Gotcha. Are there some red flags that investors should be cautious about when diligencing a potential company or investment?
Yeah. Yeah, I mean, there's many. I'm not in a position where I'm actually deploying capital. That's something that I would like to be doing in the next, 24 to 36 months. But from the conversations that I've had with investors, I think it's important for, and this is particularly true for science companies, because you read all about product market fit, and so much of what's in the media is really focused on like technology companies. But life science companies, it's really hard to figure out product market fit when you're preclinical, and you might not have an approved product for 8 years, if ever, right? So I think it's important for founding teams to really think about their unique science as a business and really be able to articulate the business value proposition, and then de-risk back, going from patient all the way to today, de-risking how you get from here to there. Being able to do that. And that's not something that's, I think, when you come out of, say, an academic lab, or maybe you're in pharma, but you're on the science side of pharma. I mean, you've got to put on like your business hat. And I think that's challenging. And where conversations that I've had with some, successful multi-exit founders was like, they often see first-time founders kind of struggle with articulating how their science and their IP could be a viable business.
Yeah.
And then the other thing, and it's like super intuitive, but an investor that I connected with earlier this year told me this. He's like, he gets an email from a company, from, let's say it's from Ray. Like, he goes and looks up Ray on LinkedIn, and if Ray's background on LinkedIn doesn't match the summary of the business, it's like it's an immediate pass. And it's like, yeah, that's a logical filter, right? Again, it gets back to the competitiveness and the scarcity of capital, right? There are, if you think about it from allocating capital and taking a bet, it's like, why would I bet on Ray, who's a bright guy, and maybe his idea is great, but Ray's never done this. Not saying you can't raise money, but you're not going to raise money from that investor.
Just the level of
And
confidence isn't there as
yeah, I think it's a lot of things, but it was kind of like yeah, that makes a lot of sense. And it even made sense because I was talking to him about something that I wanted to do for him. And he's like, "Well, I would never think to hire you to do that because you've never done that." And even though I might say like that's what I want to do, or I have aspirations to do, or I can do it, he's like, "But you've never done it, so I wouldn't put any weighting on your ability to do that."
well, it's about minimizing risk, right? And it makes total sense
Right.
to do that.
And I think that's what I think is, I think there's this notion that venture capital exists to fund moonshots and ideas, and I'm not saying there's not a part of it that doesn't do that, but when you really boil it down, it's like the funds are selling a product to limited partners, and that product is capital, return on capital. And the if you can find some of these in the public domain, find how GPs are pitching to LPs. Look at how much they talk about financial metrics and portfolio construction and history versus, we funded Ray's awesome life science company that's going to cure. They don't talk about that.
Interesting.
They talk about the math. And so I think it's just something that is missing in the arc of education for founders.
Do you think that mentality is changing at all? Like, are you seeing alternative models for VCs or maybe like these boutique companies that are more?
Yeah, I don't know. I mean, it's cyclical, right? I think right now you're getting there's a lot of angst,
Yeah, I feel that.
right? We're in a really interesting period of time here. I think LPs are questioning their allocations. GPs are, rationing their portfolios. Portfolio companies are, unfortunately going to have to shut down or merge and so I think I think like any crisis, there's things that come out of it where people start to question like, why do we do this? Like, why does Tiger Global raise all this money and blow it out in a really short period of time? And I don't know if they're going to get any of it back. Like, does that make sense? Think about some of the technology that's in place right now. Like, look at the function of just what VCs were doing in terms of taking a pool of money and allocating it. Does AI, not to ride that hype train
No, it's fair.
any further than it needs to go, but does technology enabled allocation influence things for the better? Meaning lower fees, less bias in decision making. I think that's a big problem.
In what way?
Uh,
Bias.
oh well, bias around first time founders, biased around founders from diverse backgrounds. Um, it it's it goes both ways, right? It's LPs investing in emerging managers who maybe have a different track record or a different network. I just think like the 08, 09 kind of crisis was kind of all this stuff going on with bigger issues around global finance. This issue, I think, is really just an overcooked capital market liquidity issue. A lot of money was deployed into companies. My sense is that there's going to be a reconsideration that gets done throughout the whole supply chain
Hmm.
and questioning like, is this really the best way to generate? If I have an endowment or a pension fund, are there alternative ways to generate the levels of return that I need? Or is it, and I think you're starting to see, some of those conversations. Like I said, every crisis always brings forth some like, hey, why are we doing it this way? This seems kind of silly. Like we lost a bunch of money, or um, we were told we would get this type of return and we didn't. And then plus you get the macro environments change too, right? With interest rates where they're at, I think you're going to see a rotation out of some of these alternative asset classes because there's better, maybe arguably safer places to put your money to generate the returns that you need. So I think we're still in the middle of an unwind. It's going to take some time to figure this out, but I wouldn't be surprised if there's some technology solutions or a remapping of the ecosystem that comes out of this.
Interesting. Yeah. I mean, even now you can probably make more money putting your cash into a CD in a bank in a way.
Yeah, I mean, I think there's still. I mean, I think there's still going to be a case for alternative assets,
What do you think about like
like
the
any.
blockchain industry and crypto and that alternative class of assets?
I haven't spent a whole lot of time, honestly. I'll parrot what everyone else says. I think there's probably some technical interest in the blockchain itself, but in terms of crypto, like I can't really say I understand the potential of that. Um,
Yeah.
I'm kind of a simple person in a way where it's like most of the stuff that I'm doing seems to work okay. I don't, I'm not clamoring for a decentralized banking platform. I don't know. But I think in some respects, it's back to what I mentioned earlier, right? Like in a way, it's kind of like people at the frontier pursuing technical challenges. And one of the things that I've observed is that, and I think history plays this out, is there might be a use case for something that was born out of a crypto speculative currency that gets repurposed a decade from now to do something maybe arguably better than speculating. I don't know. So
I don't either.
there could be hope for something like that.
Yeah, and only time could tell, I suppose.
Yeah.
Derek, this has been a really fascinating conversation. I do appreciate your
Yeah.
time.
Enjoyed it.
Thanks for answering my questions. And
Sure.
looking forward to following Synthase on its journey as well. So let us know how we
Appreciate
can
it.
help there. And for the folks listening, please do like, subscribe, share this. And yeah, anything else you want to leave the audience with before we end here?
No, it's been a pleasure. Really appreciate your time. It's a great opportunity to share some of my views and welcome any feedback from any of your listeners. I'm on LinkedIn, and yeah, I think you're going to include my details on the podcast summary. So again, appreciate it.
Sounds good.
Take care.
We'll be sure to include those.